Money is one of the most fundamental yet misunderstood aspects of modern society. It permeates every facet of our lives, from how we trade goods and services to how we measure and store value. But what is money, truly? Even central banks, such as the Federal Reserve, outline specific attributes that define money. These attributes include being a store of value, a medium of exchange, a unit of account, and possessing fungibility and divisibility. Yet, when scrutinized under the lens of these criteria, especially the first one, a store of value, modern fiat currencies fall short. The very existence of inflation challenges this foundational characteristic, leaving us to question whether our understanding of money aligns with reality. To understand why fiat currencies fail as a store of value, consider the inherent contradiction of inflation. Inflation erodes purchasing power over time, meaning that what $1 buys today is less than what it could buy 10 years ago. If a currency does not retain its value over time, it cannot be a true store of value. Yet, all fiat currencies in existence today, whether the US dollar, the euro, or the yen, are inflationary by design. This inflationary nature stems from the mechanism by which fiat currencies are created. They are borrowed into existence. When a dollar is borrowed into existence, it carries with it an obligation to pay interest. However, the currency to pay that interest does not exist until it is also borrowed into existence. This creates a perpetual cycle of debt that grows exponentially. For example, if you borrow $1 today, you owe that dollar plus interest. To pay the interest, more currency must be created, which itself accrues additional interest. Over time, this system ensures that the total debt always exceeds the available currency, making it mathematically impossible to repay all debts. The creation of fiat currency involves a process called fractional reserve banking. When you take out a loan, the bank does not hand you money from its reserves. Instead, it creates new currency by typing digits into your account. This newly created currency appears as both an asset, the loan, and a liability, the debt owed to the bank. As you repay the principal, the currency used for repayment effectively vanishes from existence. However, the interest remains, requiring more currency to be created to fulfill the obligation. This system is not limited to individual borrowers. Governments, too, participate in this debt-driven model. Central banks like the Federal Reserve facilitate this process through policies such as quantitative easing, QE. In QE, central banks purchase assets like government bonds or mortgage-backed securities from financial institutions, injecting new base currency into the system. This base currency, which exists in the form of bank reserves, does not circulate among the general public. Instead, it is used for interbank settlements, creating an illusion of liquidity without addressing underlying economic disparities. Base currency comprises two forms: physical cash, paper notes, and bank reserves. Physical cash represents a small fraction of the total money supply, while bank reserves play a crucial role in the financial system. These reserves are used exclusively for transactions between banks, such as settling payments or providing short-term loans. For instance, if you write a check, your bank transfers an equivalent amount of reserves to the recipient's bank to settle the transaction. The majority of the money supply, however, exists as bank credit digital entries in accounts that represent promises to pay. These digital dollars are not money in the traditional sense. They are reminders of obligations owed by banks to their customers. This distinction highlights a critical flaw in fiat currencies. They are not backed by tangible assets, but by promises that can be diluted through inflation. Inflation is often described as a hidden tax, eroding the purchasing power of money without the need for explicit taxation. It occurs when the money supply grows faster than the production of goods and services, leading to higher prices. Central banks often justify inflation as a necessary tool for economic growth, targeting an annual rate of around 2%. However, this policy benefits a select few, such as banks, corporations, and asset holders, while disproportionately harming ordinary citizens. Quantitative easing provides a stark example of this disparity. When central banks inject new currency into the financial system, it often flows into asset markets like stocks and real estate, inflating their prices. This process enriches investors and institutions that own these assets, while wages and savings struggle to keep pace. The result is a widening wealth gap and a system that rewards speculation over productivity. To understand the true impact of inflation, it is helpful to consider a concept called CUP inflation currency units per person. This metric measures the total money supply divided by the population, providing a clearer picture of how much currency is available relative to the number of people using it. Unlike traditional inflation metrics, which focus on consumer prices, CUP inflation accounts for the dilution of purchasing power caused by an expanding money supply. If we applied this concept to include assets, like stocks and real estate, in inflation calculations, the results would reveal the extent of wealth redistribution caused by monetary policies. Every new dollar created must go somewhere, whether into groceries, gasoline, or speculative investments. By understanding this dynamic, individuals can better prepare for the economic consequences of inflation. Amidst the flaws of fiat currencies, gold and silver stand out as enduring alternatives. Unlike fiat currencies, they are not created out of thin air and cannot be diluted through inflation. Their intrinsic value comes from their scarcity, durability, and historical role as money. Throughout history, gold and silver have served as reliable stores of value, preserving wealth across generations. In the current monetary system, gold and silver offer a hedge against inflation and financial instability. As fiat currencies lose purchasing power, the value of precious metals tends to rise, reflecting their status as safe haven assets. This dynamic is particularly relevant in times of economic uncertainty, such as the upheavals expected in the coming decade. The global monetary system is approaching a turning point. Decades of debt accumulation, currency manipulation, and unsustainable policies have created a fragile financial environment. Central banks face a dilemma: continue inflating the money supply to sustain the system or risk a deflationary collapse. Either scenario carries significant risks, but one outcome seems increasingly likely: a shift toward alternative forms of money. This shift could take many forms, from the adoption of gold-backed currencies to the rise of digital assets like cryptocurrencies. Regardless of the specific outcome, the transition will challenge traditional notions of money and force individuals to re-evaluate their financial strategies. For those who understand the principles of sound money, this transition represents an opportunity to preserve and grow their wealth. The more one delves into the intricacies of the monetary system, the clearer it becomes that fiat currencies are an illusion, a system designed to benefit the few at the expense of the many. By understanding the mechanisms of inflation, debt-based currency creation, and the role of central banks, individuals can make informed decisions about their financial futures. Gold and silver, with their proven track record as stores of value, offer a beacon of stability in an uncertain world. As the global economy navigates the challenges of the coming decade, knowledge and preparation will be the keys to thriving in the face of change.